Welcome to the Daybreak Asia podcast. I'm Doug Krisner. China seems to be at a crossroads these days, and Beijing seems to be acutely aware of that fact. The challenges are many, although I think it's fair to say that a lack of confidence appears to be the most significant hurdle. Just yesterday, we learned that consumption unexpectedly slowed in November as the effect of some recent economic stimulus faded. And officials have been signaling stronger stimulus to boost consumption. This is a major shift in the government's thinking. Let's take a closer look now with where things stand in China with Joe Ngai. He is Greater China Chairman at McKinsey & Company. Mr. Ngai joins us from our studios in Hong Kong. Thank you for taking the time to chat with us. I'm curious about your analysis, given the dynamics in the Chinese economy. If you had to pinpoint one thing that really needs to change in order for China to thrive, what would it be?
Doug, first of all, thank you for having me here. I think that confidence in China definitely is the number one topic, and I think that has been probably for the last 2 years. I do think that we are moving from I would say the last 2 decades of, kind of breakneck growth, right, into all of a sudden in the last 2-3 years, there seems to be the recognition and maybe a acceptance that growth going forward is going to be very different from the context from before. But what you have is that in the past couple of years, there actually has been quite a lot of supply, right? Whether this is going to be industrial production, whether these are, flats being built. I think that the engine that have powered China in the past 2 decades didn't actually stop until quite recently. So all of a sudden you have this massive, I would say, supply demand that needs to be recalibrated. And there needs to be a expectation management from corporates right into citizens, into governments, that we're going into a period of much more moderate growth like the rest of the world has been seeing. So I do think, Doug, that actually has been part of the period where, all of a sudden, you lose a bit of confidence. You see a lot of, China now is the most massive savers in the world. It's like 35% of private savings right now, savings rates. And so people are very uncertain in this period of recalibration. And I think that's what you're seeing. So the hesitance to do anything and to invest and to spend is pervasive in the economy right now.
When you hear the term overcapacity, is that apt? Does it help describe a little bit of what's happening on the industrial side?
Well, I think that, we actually have been, seeing in China in the past 2 decades where they feel like if I actually have the capacity to build and I have the, efficiency to do something that is, more valuable money in the rest of the world, I can export my products. I think that equation have changed a little bit now that there has been a lot more, I would say, industrial protectionism around the world that will change the equation. Now, when you change it, I think that, the factories in China need to, get used to that. But unfortunately, in the past 2 years, they actually have been building, to cater for that demand. And I think that what you're seeing right now is there's not a lot of new capacity being put on right now, but you're seeing a little bit of digestion of the past 2 years of capacity that's being built. So I do think that it is a oversupply in the sense of a slowing demand, what you see around the world and in China. But at the same time, the saving grace is that I would say that the investment has been really, really muted in the past 12 to 18 months. So the new capacity is going to be much, much slower.
So you alluded to this idea of protectionism, and I want to explore this a little bit if I can. The threats here being made by the incoming Trump administration in the U.S., tariffs on imported Chinese goods. And I'm aware of how many of the companies doing business in China have already begun to reconfigure their supply chains. Do you think the tension between Washington and Beijing that we're likely to see after the first of the year is going to begin to shift trade flows in a major way, or is this something that will probably get worked out through negotiation? How would you evaluate that?
Well, Doug, this is not news, right? This has been going on for the last few years. If you are a Chinese manufacturer, right, or anyone who's doing export business, you have been dealing with actually a shifting trade in the past few years. In fact, I would say that 3-4 years ago, they were much less, I would say, ready for the tariffs and for all the trade shifts that's going on. Right, China Plus One is a well documented strategy by both multinationals as well as Chinese companies. So what you see when China, exports to the U.S. have dropped from, until now only 15% of U.S. imports are from China. You see, correspondingly, the Chinese trade is going to Southeast Asia. ASEAN right now is the largest trading partner, right, to China. You see actually a lot more Chinese, we call it the global South trade that's going on. So I absolutely think that the trade patterns are being reconfigured, and that has been going on. So I would say with the new administration coming in, I think it's a continuation of what we're seeing. Would that be an acceleration or continuation? I don't know. But I think that it is certainly not news. And I think at this time, I think that everyone is, in some ways much more prepared, for the uncertainty of this to happen.
I have to ask you about high technology, particularly as it relates to artificial intelligence. One of the things we know that the Biden administration has done is to restrict Chinese access to specific semiconductors and other equipment they may be used kind of in the pursuit of artificial intelligence. Where is China right now in the race for AI?
I think in the, I would say, high-tech world, especially in AI and semiconductors, I think it's very clear that, it's going to be a very domestic game in China. I would say that in the past couple of years, there has been a big ramp up in terms of Chinese local R&D investment, especially, I would say, into semiconductors and into, AI, into, areas where they foresee that it would very likely be a world where it will be China for China, and I think that it won't be able to access many of these, I would say, leading technologies in the U.S. I think that self-sufficiency drive is motivating quite a lot of capital and internal, I would say, talent that actually has been really, thinking that, well, in some ways it's an opportunity because before there's been reliance, right, on, the areas that we didn't need to invest in. However, I think that investment have been ramping up. I would say that's probably the area where you see the most inflows of capital within China into these sectors right now. Mr.
Ngai, we'll leave it there. Thank you so much for making time to talk with us. Joe Ngai is Greater China Chairman at McKinsey & Company, joining us here on the Daybreak Asia podcast. Welcome back to the Bloomberg Daybreak Asia podcast. I'm Doug Krisner. We're less than 2 days away from the Fed's final policy decision of the year, and most officials have preached patience and data dependence. Although if you talk to folks in the marketplace, they are widely expecting another rate cut. Joining us now for a closer look is Chuck Cumello. He is president and CEO of Essex Financial Group, joining us from just outside of New York City in Connecticut. Chuck, thanks for being with us. I'm curious as to whether or not your view is aligned with what the market expects, that we're going to, in fact, get this 25 basis point rate cut this week.
Well, thank you so much for having me. Yeah, listen, that certainly seems to be the case. I mean, the last number I saw was a 97% probability that they were going to cut by 25 basis points in this upcoming meeting. So that is what the expectation is. But it's not 97% certainly is a huge number. But when you peel back where the economy is, where jobs are, it's you could certainly make the argument that like standing pat right now would not be a bad idea either.
But isn't the bigger issue where the Fed goes from here?
Oh, well, 100%. I think where the Fed goes from here, as long as things go according to their plan and stay on the same trajectory, is lower. But, you've got and they've always been very data dependent. But, there's potentially some bigger changes coming down the pike with President Trump coming into office, talks about tariff, talk about deportation, which could have an effect on the labor market, and again, all the government spending, all of which is very inflationary. And we just saw the most recent, CPI number and the PPI number come in a little bit hotter than expected, just a little bit. But their nightmare scenario is have to raise rates. So again, there's plenty of people that think they should stand pat. We certainly do think that the trend longer term is for rates to keep coming down. But listen, getting from 9 to 2.8 was, I won't say easy, but it was easier. It's this last bit to try to bring it down to 2 that is going to be really difficult. And I think the jury's still out whether they can actually pull it off.
Friday, we're going to get the Fed's preferred measure of underlying inflation. That's the PCE. So core PCE, from what I've been reading, will probably, if you talk to the economist, you look at our survey, we're thinking maybe a gain of 0.2%. The other thing that's going to be interesting to see is whether or not consumer spending holds up well, that it's still solid, and income growth also does well in terms of some of the gains that we have seen recently. If you look at kind of the broader economy where the consumer is concerned, how would you evaluate it?
I think overall the consumer is in really good shape, and the most recent retail sales number bear that out. But the big thing right now that's really helping the consumer has been the market and this the wealth effect that of the U.S. consumer, I shouldn't say the majority, that a good chunk of the U.S. consumer feels. And what I mean by that is in Q3 there was a 2.9% increase, which equates to $4.8 trillion in net worth for the U.S. consumers, which brings it to almost $169 trillion. Most of that $4.8 trillion in Q3 came from the equity market. So, the part of the U.S. consumer, again, it's a bifurcated consumer base. Those consumers, the more, higher net worth, mass affluent type consumer, is doing just fine and is feeling really good. But there's a lot of people in this country that don't own stocks and aren't feeling the benefit of that. And that's where you're seeing, again, one chunk of the population doing really, really well and one still struggling. And again, for that part of the population in this country that's struggling, the absolute worst thing is inflation. And that's why I think it's the Fed's, again, nightmare scenario to have to raise rates. But here's the thing, by and large, the equity market's very strong, a lot of bullish sentiment. It's certainly done extremely well since the election. And that is just, the U.S. consumer drives 2/3 of the U.S. economy. And that part of things right now is doing extremely well. But if that does go sideways, then that's going to be a major, major headwind.
You were talking about the chance that the Fed may have to consider some of the economic policies of the Trump administration. And I think with that, there are potential inflationary implications, whether it's restrictions on immigration, whether it's the tariff issue. The other thing we have to talk about at some point, tax cuts. But I was struck today by this announcement from SoftBank Group that it plans to invest $100 billion in the U.S. over the next 4 years. Generally speaking, when you look at what we're hearing coming from the incoming administration, how do you think it's going to set up the economy to perform not only in 2025 maybe, but over the next 4 years?
So I think there's an awful lot of tailwinds behind the U.S. economy right now. So that announcement today from SoftBank also, mentioned 100,000 new jobs in AI and infrastructure, construction, et cetera. But there certainly is a palpable sort of feeling of optimism across the country. Now that the election is over, the feeling that the economy will be more unleashed, I certainly don't want to get political, but, the regulatory environment over the past 4 years was challenging, for U.S. business. And I think the feeling is that now there's a lot of wind in the sails, and there's tremendous optimism moving forward. Listen, there might be too much optimism. We might have pulled some of that forward. So I think we're going to see and run the risk of seeing a lot of volatility in Q1 and Q2 of next year. But overall, that feeling in the U.S. right now is very positive in just about any place you look.
So in terms of an investment strategy, are there corners of the market that you want to be focused on primarily?
Yeah, we'll see. It's a great question. So obviously, tech continues to work. It's been overvalued for, 40 percentage points of total return for quite some time, right? So you don't own it at your own peril. But I think there's also opportunities in areas, that haven't done as well when you look more, longer term. Healthcare is in a tough spot right now. That is I think the jury is still out on things like that. Energy, small caps, mid caps. There's a lot of different areas. And again, yes, technology has run, but these are world-class companies doing unbelievable things, with tremendous free cash flow and with still a lot of room to run. I mean, you look at, Broadcom over the past, 5, 6, 7 trading days, the run up it's had as different areas. It has different areas, right? And and NVIDIA's done nothing over that period of time other than come down. So there's a lot of different areas to go. But I think what we're trying to share with our clients is, listen, there's no doubt right now valuations are stretched and extremely stretched in certain areas. So again, you leg into this market. Dollar cost averaging is a great thing. right? Spread this money out because, again, we do truly feel that you certainly will see some volatility as we get into Q1.
Yeah, I'm glad you mentioned Broadcom. Over the last 2 days, I believe the stock is up 38%. It's now into that $1 trillion market cap club. Given the gains that we have seen here in the U.S., I'm wondering whether you want to be diversified just a little bit offshore. Is that saying too much?
Well, that's a tough sell. I heard someone say, the United States is innovate, the Europeans are regulate, and right now, if you look at sort of the EFA market over the past 1 year, that's up. The MSCI EFA index is up about 11.35% over the trailing 12 compared to 30 for the S&P 500, 36 for NASDAQ. Listen, there are some great opportunities overseas, but, it's been a drag on a portfolio. And I think that is also where active management really, really is important so that, you're not just buying everything, you're buying the best of breed companies. We always say, especially it's underperformed for so long, it's always worthwhile having some international, 10, 15% maybe. But right now, the U.S. has been so dominant for so long, it's hard to see that changing, especially with the regulatory and political climate in Europe.
So if you're convinced that there is some risk that the Fed may have to adjust its rate of rate cuts to a slower pace, do you want to avoid the bond market right now?
No, I don't think you avoid it. No, and again, with the Fed, I think you're probably just more of them being in more of a wait and see, a wait and see position. So I think you get to 25, coming up this week, and then I do believe, given all the different inputs that they're looking at, that they certainly are well served by saying now we're going to pause and just sort of see how this works out. Right? It's long lags of monetary policy, but with the bond market, listen, I think the best thing to do in the bond market is to diversify, right? Whether it's short, intermediate, long, and especially depending upon the client, private credit has really provided a nice return and a nice income stream for those clients where that's appropriate for. But no, I think you don't avoid it because we do think that the longer term trend for the Fed is lower. So people that are sitting in cash, sitting in money markets, right, that's going to come down. You've already seen it in money markets. You're going to see it in treasuries. But, there's nothing wrong with having some portion of money in treasuries and then ladder out, whether it's through mutual funds or through individual securities or ETFs, a nice diversified bond portfolio. And there's some great managers, great active managers out there, both on the mutual fund side or ETF side, that can build a really solid long-term fixed income portfolio.
Chuck, we'll leave it there. It's always a pleasure. Thanks for catching up with us. Chuck Cumello is president. He's also the CEO at Essex Financial Group, joining us here on the Daybreak Asia podcast. Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.